Welcome back to your personal finance classroom, where we break down your money questions to make it easy for you to live your best life. Don't forget to subscribe and hit that notification bell so you can be notified when new videos come out. And if you found this video helpful, don't forget to like it. Today, we're continuing our credit score series by diving into the question, how is my credit score calculated? Credit is the ability of someone to obtain goods or services before payment based on the trust that payment will be made in the future. And your credit score is a prediction of your credit behavior. This is what lenders use to determine 1, whether or not they want to work with you, and 2, if they do decide to work with you, how much they'll let you borrow and what the terms of the agreement will be. You might notice that your credit score varies depending on where you're looking at it. Equifax, Experian, and TransUnion are the 3 major credit bureaus that your credit score is reported to. It's normal to have different scores across all 3. Each credit score is determined by the information used to calculate it and can be different depending on the scoring formula used. In general, there are 2 main credit scoring models, FICO and Vantage score. Both formulas consider similar aspects of your credit history, but they each use their own formula to calculate that score. And the formula might look different depending on what type of loan you're looking for. For example, if you are applying for a mortgage, the lender might use a mortgage-specific formula to determine your score. Most credit scores range from 300 to 800. With a FICO score, very poor is considered 300 to 579, fair is considered 580 to 669, good is considered 670 to 739, very good is considered 740 to 799, and excellent is considered 800 to 850. With a Vantage score, very poor is considered 300 to 499, poor is considered 500 to 600, fair is considered 601 to 660, good is considered 661 to 780, and excellent is considered 781 to 850. It's important to note here that, in general, a FICO score is the most popular scoring formula lenders use, but it's helpful to understand the breakdown of each. A good credit score offers better access to loans or credit cards with better terms. A good credit score can mean things like a cheaper way of borrowing money. When you take out a loan, you're not only paying back the money you borrowed, but you pay interest as well. Interest is the cost to borrow the money. With a better credit score, you'll likely have access to a lower interest rate, which means you'll be paying back less money over time. It also means access to better credit cards and access to more housing options. Between mortgage rates and applying for apartments, a good credit score means more options. So let's talk about what goes into your credit score. There are 5 main factors that determine it. Number 1, payment history. Your payment history accounts for 35% of your FICO credit score, and with a Vantage score, it's considered extremely influential. This represents whether you make payments on time, how often you miss payments, how many days past the due date do you pay your bills, and how recently payments have been missed. The higher your number of on-time payments, the higher your credit score. And similarly, the more missed payments you have, the lower your credit score. Multiple missed payments means your credit score will take a harder hit. Since a good payment history has such a big impact on your credit score, it's important to make paying on time a priority. If you have a history of missed payments or late payments on your record, all is not lost. Create a plan to catch up and then set up automatic payments each month to ensure you're paying on time. With a good effort, over time, your credit score will increase. Number 2, the amount of debt you have. The amount of debt you have accounts for 30% of your FICO credit score and is considered highly influential with the Vantage score. This includes the total amount of debt you have, the number of accounts you have, and the types of accounts, for example, credit cards, mortgages, auto loans, student loans, and so on, and most importantly, your credit utilization ratio. Your credit utilization ratio looks at how much credit you have available and how much of that credit you're using. For example, if you have one credit card with a $6,000 credit limit and you spend, on average, $3,000 a month on your card, your credit utilization ratio is 50%. If you had 2 cards with a $6,000 credit limit, your overall credit limit would be $12,000. And if you're spending $3,000 a month on average, your credit utilization ratio is 25%. Another way to think about it is that someone with a balance of $100 on a credit card with a $1,000 limit is considered more responsible than a person who has a $10,000 balance on a card with a $12,000 limit. A good rule of thumb is to keep your utilization below 30%. Luckily, installment accounts like a mortgage, student loan, or auto loan don't work the same way as credit utilization. Typically, if you're paying those on time, the amount you borrowed shouldn't have a negative impact on your credit. The scoring formula will take that type of account into account as it calculates your score. Number 3, the length of your credit history. The length of your credit history accounts for 15% of your FICO credit score and is considered highly influential with a Vantage score. Lenders like to see a long, steady credit history. They look at things like how many years have you had credit obligations, how old is your oldest account, and what the average age of all your accounts is. It's a good idea to keep credit card accounts open even if you aren't using them anymore. The age of your accounts can help keep your score up, while closing credit accounts can potentially mean a decline in your score. Just make sure to check for annual fees on any credit cards you leave open so you're not taken by surprise. And number 4, the types of accounts you have. The types of accounts you have make up 10% of your FICO score and are considered highly influential with a Vantage score. This means having a variety of accounts like a mortgage, auto loan, personal loan, student loan, retail cards, and credit cards can help improve your score. If you don't have a variety of accounts, that doesn't mean you have to apply for more to show variety on your report. In some ways, that can actually hurt your score. With a FICO score, it factors in less, and with a Vantage score, it's considered highly influential alongside the length of your credit history and your credit utilization. And finally, number 5, recent credit activity. Recent credit activity accounts for 10% of your FICO credit score and is considered less influential with the Vantage score. This means that opening new accounts or applying to open new accounts can potentially hurt your credit score. When you apply for a new credit, the lender checks your credit report, which is known as a hard inquiry. It doesn't mean you can never open a new credit card or loan, but it's a good idea to limit hard inquiries, so be intentional with applying for credit accounts and avoid impulse applying for credit. One of the biggest culprits of impulsive credit applications are the store cards that cashiers will constantly ask you to apply for in exchange for a percentage off your purchase. Most of the time, it's not worth it. Again, this is only a small percentage of your credit score, and a hard inquiry will only stay on your account for 12 to 24 months, but it is important to note. Remember, these 5 things work together to make up your credit score. Some might be weighted more than others, but it's important to keep each of these in mind when it comes to the full picture of your credit score. And if you don't have credit yet, or you're worried you have bad credit, check out our video on how to get credit when you don't have credit or have bad credit. We'll link it in the description. And before we wrap up this lesson, we just wanted to share a few quick tips for improving your credit score. Aim for a variety of open and active credit accounts. Take a look at your current credit report and see where there may be gaps. Come up with a plan to space out any applications and try to fill in those gaps. Don't miss any payments. Whether you need to set a calendar reminder or you need to set up an automatic payment, make it a goal to have a perfect and long history of on-time payments. Even if you can only pay the minimum for now, remember how important those on-time payments are. And if you're struggling to pay off more than the minimum, check out our video on reliable ways to pay down debt. We'll link that in the description. Play catch up on any past due accounts, keep your credit utilization under 30%, and limit those new account applications. Avoid an excessive amount of hard inquiries and be strategic with when you apply for new accounts. And you can also check out our video answering the question of how many credit cards is too many. After all of this, if you're wondering what your score is and your report looks like, you can visit annualcreditreport.com to get a free credit report each year. And that wraps it up for today. We hope this helps give you a good picture of what goes into your credit score. Don't forget to like and subscribe. We'll be back Wednesdays and Fridays with new personal finance lessons for you.